Now let's shift our focus to Patanjali. Now we spoke to the CEO Sanjeev Asthana on the company's progress in the HPC business and more. Listen in to the slice of the conversation.
So the business is already integrated from November 1st this year. We are in the process of getting all the other systems sort of working. The sales continue, at full pace, and we are very confident that this integration will be successfully done. And we'll start reporting the results from this quarter onwards. And for this quarter, we'll get 2 months of results of HPC business as well.
Right. So with regards to the integration now, that's the home and the personal care business, which we call the HPC business, how much of a revenue that you're eyeing from here, which will come in the current financial year?
So look, the business last year was about 2,800 crores, a little less than that. And this year we'll get a full 5-month window on that. So we're anticipating that we should do close to about anywhere between 800 to 900 crores of business. And from next year, April 1st, 25 onwards, we should be fully onboarded. And we expect to grow that at 15% year on year. That's a target that we have.
Right. So initially, when we were talking about the HPC business with you as well, when you had got the notes, the idea was to garner around 1,100 to 1,100 odd crores, if I'm not mistaken, from HPC. So is this due to any delays that you've cut it down to 800 crores of the contribution that will come in, or am I missing something?
No, not at all. I think the only part is that, the early part of, the period, when we sort of acquire a business, there is some sort of adjustment time, that the lead time that is, that's already always there. So I'm not anticipating any slip ups or otherwise. I think 1st December onwards, we are fully on course. So the business typically does about 225 odd crores a month. We anticipate pretty much in the 5-month window, we should be very close to that number. It's just a conservative estimate that I gave you, that 800 to 900 crores is definitely given. And barring some changes, we could also hit that 1,100 crores, which you are pretty confident about.
Right. Moving on, another aspect that if you talk about FMCG companies as a whole that are striving with from an input cost perspective is the way palm oil prices have been panning out, right? Now, how are you looking at that segment? Because how does it benefit a company like yours, basically?
So there are two sort of parts to the oil palm. So one is that high oil palm prices are very beneficial for our oil palm plantation business. Basically, that works on the international prices, which are benchmarked, and based on that, we buy our fresh fruit bunches. So it is beneficial both for the farmers as well as for the company. That's one part. The second is that a business like ours, which typically operates on a long only basis, which means that we are buying ahead of time and then selling. And if the prices tend to spike up, it is normally very beneficial to the company. But that is a one-off benefit. But longer term, we believe that, the prices are going to stabilize, which they are right now. And the benefit which is accrued in this quarter, part of that will accrue in the next quarter as well. And then the market will stabilize itself at the new benchmark levels. So overall, but the problem statement here is, which is, for a lot of companies which are the FMCG space, this inflation also gets into the higher cost structures in business like biscuits, confectionery, wherever the oil palm usage is very high, including soaps and otherwise as well. So that part, the companies have to calibrate their strategy, their buying strategy on how they do. So two parts of it are very beneficial for the company. One part, we need to deal with it. We need to figure out a way of being more efficient. And that is what the company is working towards.
Right. So if you have to look at the revenue contribution that you get from palm oil plantations, right? Are you expecting that to increase as well? Because you've already expanded your cultivated land by over 5,200 hectares and you're aiming for almost 0.5 million hectares over the next 5 years. That will cover 60% of the palm oil requirement in the country. So what is the strategy going to be from here on, and how will it impact revenues and margins?
So it's very positive. Oil palm plantation as a specific business. Currently, we have about 80,000 hectares which are planted. of which nearly 30% of the area is between 0 and 3, which means we've got a fairly young plantation. Every year, we expect the EBITDA addition to our business of by almost 10% each year. And year 4 onwards, we expect a substantial uptick. So, for example, we made last year about close to 190 crores on the oil palm plantation. This should continue to increase at the pace of 10% year on year for 3 years. And every year, when the new set of plantations start to fruit and they start to sort of get delivered to us, our margins will continue to increase. And longer term, the plan on 0.5 million hectares that the strategy is, it should give us more than 1.2 million tons of oil. It should be hugely beneficial for the company. And for next 25 years, it could potentially give a margin profile of anywhere between 800 to 1,000 crores on almost a consistent basis for 25 years.
Okay. Moving from this portion, if you look at e-commerce and quick commerce trends, right? How are they auguring in terms of growth for you? Because 12% of FMCG volumes come from modern trade, e-commerce and quick commerce. Are there any plans to increase it further? And if yes, at what cost?
So currently, we have about 2% plus sale, which moves through quick commerce, e-commerce, and D2C. We have stated that before, that we'd like this to be doubling over the next 2 years. So there's a full effort which is going on for our overall sale. We would like 4% of the revenues coming from e-commerce categories. And we'd like the current share of 6% of the modern trade to go up to 8%. So we should be 12% plus between e-commerce and modern trade. And that's a very stated intent that we have. There's a full work which is going on. Our presence on the social media, on the digital commerce platforms has increased substantially. We are deploying a serious amount of resources and money there. So we're pretty confident of meeting our objectives of doubling our e-commerce revenues.
Right. And how do you play the FMCG part of the business? Because that has been under pressure. Across categories, you're seeing pressure specifically from an urban perspective. Rural, probably there is some bit of a pickup that has come in. Rising costs again in terms of palm oil and wheat are hurting that business of yours, right? So how are you going to balance that out? I mean, in terms of FMCG as a business as well.
There are two parts to it. I mean, clearly there is a stress, we can witness. There's a slowdown in growth. It is not degrowing. There's a slowdown in growth in the urban consumption sort of basket. So the two, and rural, to the contrary, has been positive. So overall, a company which has got 60-40 share, I mean, we do 16 urban areas and 14 rural. So while it is supportive to rural, there is some sort of signs of, challenge that we see in urban areas. But there is an enormous amount of opportunity which the company has. Our reach today is, about 3 million outlets. So we are not saturated by any stretch of imagination. There's a lot of scope to improve through, as an omni-channel strategy which the company follows. So whether it is the general trade, modern trade and e-commerce, which I spoke about, so we are reasonably confident of achieving 10% growth in the foods FMCG space and about 15% in the HPC. And that is a stated intent with which the company is working. First half was a little more challenging. We're getting into the next half, which is, more sort of festive season. Winter months typically are very supportive to, a lot of our products. So we're pretty confident of, meeting that objective growth target that we've set for ourselves.
Okay. And when you talk about even the nutraceutical part of the business, your target still remains 100 to 125 crores for FY25 with a 25% margin? Or do you think it could probably outpace that as well, taking into consideration the pace at which it's growing?
Look, last quarter was, turnaround of the nutraceutical business. We made, 5 crore margin as well on that, on a very small base. So while margin is not significant, but in terms of the restated, sort of reoriented business of nutraceuticals, I think it's a great validation. So we are committed, to still maintain that pace of anywhere between 100 to 125 crores. I think the last quarter is going to be very critical for us in how it plays out. But the confidence is that 25% margin and base number of 100 crores and aggressive number of 125 crores, we should still be able to meet for the full year.